I want to talk about the notion of panic, and more importantly, I want to talk about the idea of planning for panic. When you woke up on Saturday morning, you would have been confronted with this number. This is apparently the number of points that the Dow fell on Friday night. 318.2 sounds like a very, very large number, but this number by itself lacks context. It lacks any form of meaning. It seems like a big number. But we need, firstly, to put this number into some sort of context. So the initial context is to look at what it was in terms of a percentage fall. And again, 1.9 does seem large, but remember, during the bull run, I won't say it was quite usual for the market to go up 1.9%, but there were certainly days when the Dow went up 1.9%. And when those days occurred, it did not engender the same emotional response as going down 1.9%. This is the strange notion of trading. People forget that markets go down as well as up. There is an assumption that markets only ever go up. Therefore, the planning we undertake seems to only reflect that notion, this belief that a market will only ever go up. But markets move up, they move down, and they move sideways. Therefore, your planning must reflect this sort of approach. You must be able to deal with any and all contingencies. But unfortunately, we don't. So when we here in the Southern Hemisphere awake to the sort of headline that says that the market has just had the worst week in 19 months, it tends to engender within us panic. And we panic because we're basically emotional, but also because we are wedded to the notion of markets always going up. We lack sufficient detachment to make a logical judgment about what this means. So in terms of making a judgment, we need to look at the context of what this sort of move means. And we need to look at it in terms of what our own plan says. If we look at the S&P 500 on a monthly chart, one piece of information is glaringly obvious. The uptrend that started post the GFC actually appears to be intact. So if I were a very, very long-term investor, someone who followed very long trends within the markets, the notion that the Dow was down some 300 odd points would not be of concern to me, because I would look at this chart and note that during the bull run that has enriched me, there were months when this occurred. There were periods where the market fell back, but the trend recovered. The slight problem with this is that most of us don't have that sort of time frame. We don't look at markets in such a way. Our focus tends to be a little bit more precise in the time frames we look at. So if we scale down to a weekly chart, you can actually see that last week's activities were a bit severe. But again, if we take a step back, if we walk to the other side of the room and we look at the chart, and we ask ourselves the question, what is the long-term trend? Well, it's quite obvious. The long-term trend is still up. But note, it appears to be up. And I say appears because everything with markets is contingent. We are looking backwards. I know this is a point I harp on continually, but it is a point that is so important that I have to do so. We have no predictive ability whatsoever. When we are looking at a chart, we are looking at history. We're not looking at tomorrow. We're looking at yesterday, last week, last month, last year. We need to be acutely aware of that. So therefore, whatever we do must be reactionary. It is not predictive in any way, shape or form. We are continually on the back foot. And we need to be aware of that. And we need to be aware of what our analysis is telling us, because it is not telling us what will happen tomorrow. The past gives us an insight into a range of possible futures, but then all possible futures may come true, so we have to plan for all of them. If we step down to a daily chart, and this is what most people see, because most people don't step back enough to make a judgment about what is happening. You can see that it appears that the trend is still intact. Yes, it's a very, very nasty day. So if you were long the index coming into that day, it's been a rough day. But that happens. We can see on this chart that there have been other days like that. And they have not broken the trend that had been in play. Notice I'm talking in past tense. All charts are past tense. So throw out what the idiots that follow Gann say, throw out what the idiots who follow Elliott Wave say, and understand you are looking at the past. And this is our difficulty. We are looking at the past. We are attempting to drive looking in the rear vision mirror. And the consequence of that is that we do not know what the road ahead holds. Therefore, we need some form of plan. We need some form of structure to deal with what is happening. So you need to understand what is significant to you, what is of importance to you in the time frame you're trading. What will make you react in a different manner to the way in which you have been reacting up until now? What will alter your status quo? And I want to look at this with two examples. This is a daily chart of the Hang Seng, and my interpretation of this is that the Hang Seng has been, again, past tense, trading in a congestion zone. It has been moving up and down. And in the most immediate past time period, that is yesterday, it does appear as if it is breaking out of that congestion. It does appear as if it is moving down, but I have no confirmation of that. I have nothing as of yet to cause me to react to that. So I'm still dealing in the past. It's just I have a reaction point. And the reaction point is the blue line. So if it builds a body of evidence that says to me that the immediate past history is one of going down, then I react to that by going short. If it doesn't confirm that, if it doesn't continue, then I take no action. The same can be said for our local market. This is the All Ordinaries on a daily scale. You can see that we have this basic uptrend, but late last year, the market appeared to peak, slip away, move to a lower high, fall away, move to another lower high. So again, you've got two reaction points. So that if it moves above the previous peak, you go long. If it falls below this trend line, you go short. But again, it's reactionary. It's based upon what the market is telling you to do, not what you think is going to happen, not what you think will unfold. You're responding to the actions of something else. However, there is a problem with this. And I posted this image on the blog a little while ago. The problem that occurs when markets make these rapid and sudden shifts in sentiment is that it generates an internal response within us. We feel hurried, we feel flustered, that we must do something. In actual fact, the best thing to do is to do nothing momentarily and to sit and think and consider. You cannot be influenced by your own emotions. You cannot be influenced by the enemy within. The market is not your enemy. It never has been. The market is just a nebulous thing. It's a playground within which you exist. Your enemy, particularly within these periods of rapidly moving markets, is yourself. And the only way to deal with that is to have a plan. and to act according to your plan, not according to your emotions and not according to the emotions that are foisted on you by external sources. Talk of an impending market crash is all very, very emotive and very exciting, but it does nothing to help the individual trader. The only thing that will help you is controlling yourself and acting according to your plan.